Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on InvIT's Unlocking Opportunities and Financing. Thank you for taking the time to join us. Before we begin, I'm delighted to introduce our esteemed panel speakers today. Mr. Amit Kumar Singh, Chief Executive Officer at Indus Infra Trust. Mr. Ankit Patel, Head of Research Credit Fixed Income at HSBC Asset Management Private Limited. Mr. Gaurav Malhotra, Chief Executive Officer at Sustainable Energy Infra Trust. Ms. Meghna Pandit, Chief Financial Officer at IndiGrid Infrastructure Trust. This session will be moderated by Maulish Desai, Director at CareEdge Ratings. We will begin this webinar with a presentation by Palak Vyas, Associate Director, and Mayur Vachani, Analyst at CareEdge Ratings. After the presentation, we will move into a panel discussion followed by a Q&A session. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Palak to make the presentation.
Hi, thank you, Mamta. Good afternoon, everyone, and warm welcome to today's webinar, Unlocking Opportunities and Financing Trends InvIT. To walk you through today's agenda is divided into 4 parts. First, we'll look at the latest trend in the InvIT market. Second will be sector-wise dynamics and outlook, highlighting opportunities and risk, followed by financing trend, both equity as well as the debt side. And lastly, we shall cover the regulatory perspective, including the recent draft RBI guidelines. We shall conclude our presentation with key messages. To start our presentation, as we see from the Exhibit 1 on the left-hand side of this chart, InvITs in India have gained momentum with increase in the number of InvITs from 11 during FY22 to 22 InvITs during FY25. Simultaneously, InvIT's AUM, that is asset under management, has also doubled from FY22 to FY25 with increase in the AUM from rupees 3 lakh crores in FY22 to 6.25 lakh crores in FY25. As we can see from Exhibit 2, while the absolute AUM growth is healthy, the sectoral mix remains concentrated with telecom and road sector constituting about 49 and 39% of AUM as of 31st of March 2025. The balance AUM constituted by various asset class such as transmission, renewable, warehousing as well as pipeline, which indicates opportunity for diversification as well as growth. CareEdge Ratings expects growth momentum in InvIT to continue with increase in AUM by about 1 lakh crore for FY26, which will be led by new asset additions in road sector, transmission, warehousing, as well as renewable energy. Moving on with the sectoral trends, let's start with the road sector. So of the 22 InvITs, at the end of 31st of March, 15 InvITs were road InvITs housing of about 178 assets and having an AUM of 2.46 lakh crores. As you can see from the exhibit on the left-hand side, the asset monetization potential from the existing operational HAM, that is hybrid annuity projects, stands at about 50,000 crores, while it is expected that additional HAM of about 1.5 lakh crores are expected to be operational over next 2 years, that is FY26 to FY28, taking overall monetization potential to about 2 lakh crores. However, there remains challenges with respect to lower valuation multiples due to high leverage and aggressive bidding, leading to perceived risk of quality. Talking about the toll road project, as seen from the Exhibit 4 on the right-hand side, CareEdge Ratings estimates toll growth to be stable at 7% for FY26. But unlike HAM project, the availability of toll road projects for monetization in the primary market is limited as significant portion of the mature toll assets have already been monetized. Moving on to the warehousing segment, as of 31st of March, warehousing comprised of 2 InvITs with AUM of about 11,000 odd crores. Thrust on multimodal logistics, growth in e-commerce and demand from third-party logistic players are key growth drivers. As per CareEdge Ratings estimates, India's Grade A warehousing stock is expected to cross 500 million square feet by calendar year 30. On the demand side, despite rising rentals, the occupancy level is expected to remain healthy at 90% for FY26. Further, CareEdge Rating also estimates leverage for FY26, that is total debt to EBITDA, to remain moderate at about 4.5 times, thus supporting the credit metrics. At the same time, warehousing sector faces a challenge in terms of rising land as well as the construction cost. Moving on to the telecom towers. So as of 31st of March, there are two telecom InvITs with an AUM of about 3 lakh crores. Monetization in this sector is supported by structural demand drivers as well as stable operating metrics. So on the demand side, India's internet penetration has reached approximately 69% and data usage has doubled over last 5 years. From an operating metrics perspective, CareEdge Ratings anticipates the tenancy ratio to remain stable at about 1.4 times for FY26, with additional tenant expected to support incremental revenue generations over time. Further, improvement in the collection, with collection period reducing to almost 58 days in FY25, reflects better working capital discipline as well as improving counterparty behavior. That said, the growth in the telecom infrastructure remains steady rather than exponential, with asset concentration across a few large platforms. Moving on with the transmission segment. So as of March, there are two transmission InvITs which houses 49 assets and having an AUM of about 42,000 crores. Talking about the demand drivers, peak power demand in India is expected to rise sharply from 241 gigawatt 241 gigawatt during FY25 to 458 gigawatt by FY32. In line with this demand, there's a huge investment opportunity with planned investment of about 4.86 lakh crore till 2030-2031 as per CTU, that is Central Transmission Utilities Master Rolling Plan. This is expected to create a sustained pipeline of operational assets. Looking from a cash flow perspective, transmission assets benefit from the long-term transmission agreements, regulated or a fixed revenue stream, thus providing a stable and a strong cash flow visibility along with a lower operating risk. But despite stable cash flow, monetization via InvIT is slow due to ease of refinancing. Also, the large transmission players have relatively strong credit profile, which together reduces the urgency to recycle the assets into InvIT structures. Moving on with the renewable sector, this sector has a strong investor appetite, particularly global investors. From the sector standpoint, the installed renewable capacity stands at 207 gigawatt as of 31st of December 2025, and it is expected to reach to about 460 gigawatt by 2030. So like transmission, this too shall create a large pipeline of operational assets. Further, technological evolution in the sector, particularly in battery storage, has led to decline in the battery prices from about $800 per kilowatt in 2030 to about $108 per kilowatt in 2025. This has improved the economics of round-the-clock as well as firm renewable energy solution, as seen from the recent tariff discovery of about 2.86 rupees per unit for BESS plus solar projects. This has indeed increased the lender confidence. However, there still remains a risk with respect to evolving storage technologies, occasional delay in signing of PPA, and the bottleneck in terms of transmission infrastructure. We'll now look at data centers, which can be a potential asset class for InvIT. So as seen from the exhibit, the planned capex in the data center is expected to be about 60,000 crores over next 2 years, that is FY26 to FY28, which will be driven by rapid digitization, cloud adoption, as well as AI-led hyperscale demand. From an InvIT perspective, data center offers a stable revenue stream via long-term contract with a strong counterparties and pass-through of key costs such as power. Additionally, the recent Union Budget proposal of a 20-year tax holiday for foreign cloud service players have emerged as a strong demand booster for the sector. With this, I now hand over the presentation to my colleague Mayur. Thank you.
So moving on towards third part of the presentation, we shall have a look at financing trends. We shall have a look at financing trends of both equity and debt. Collectively, as seen from Exhibit 7, InvITs now sit on a unit capital of about 1.93 lakh crore as of March 31, 2025. with road InvITs accounting for the largest share, that is 57% due to sizable raisings by NHIT and the launch of new road platforms. Over the last 3 years ended March 2025, InvITs have mobilized roughly 88,000 crores of equity, reflecting continued confidence from large long-term investors. Equity raising momentum has continued in FY26 as well. From a holding pattern standpoint, as seen from Exhibit 8, sponsors now own 44% of units, which provides headroom to unlock equity for future growth. On the investor mix on combined basis, global investors lead with 55% ownership of unit capital, which includes foreign sponsors, foreign portfolio investors, and body corporates, as against 45% holding by domestic investors. Participation from domestic institutions such as mutual funds, provident pension funds, banks, and insurance companies remain modest at 7%. Retail ownership is still nascent but gradually rising, particularly in listed vehicles with stable distribution histories. On the global side, investor remains strong with large pension funds and sovereign pools and global investors such as Ontario, CPP Investments, I Squared, Brookfield, GIC, and KKR-backed platforms. Moving on to the next slide, InvITs on collective basis have an outstanding debt of rupees 2.82 lakh crores as on March 31, 2025. As seen from Exhibit 11, the term loan constitutes 62% of the borrowings, followed by NCDs at 20%, reflecting under-penetrated bond market. As seen from Exhibit 10 on the left-hand side, the overall debt-to-EV ratio has been hovering in the range of 47 to 51% over the last few years. CareEdge Ratings expects the leverage to remain stable at 49% in FY26 due to increase in valuations owing to low interest rates and raising of equity. This has provided headroom for asset acquisition. The repayment profile of the outstanding debt is reasonably staggered. About 20% of the total debt is scheduled for repayment between FY26 and FY28, followed by another 20% in FY29 and FY30. Interest remains elevated due to lower lender protection, with NCD coupons generally falling between range of 6.65 and 9.5%, while bank term loans range from 7 to 10%. Lastly, sustainable link financing is slowly emerging. Moving on, let's shift our focus to the regulatory side. Over the past few years, SEBI has strengthened the InvIT framework, aiming to balance investor protection, governance quality, and operational flexibility for sponsors. InvITs require minimum sponsor ownership with a defined lock-in period, ensuring that sponsors remain committed through the earlier years of the trust. At the same time, the framework puts a cap on consolidated leverage at 70%, subject to 6 distributions and maintaining AAA rating. From distribution standpoint, InvITs must distribute at least 90% of the net distributable cash flows, which is a key reason they appeal to yield-seeking investors. Investor rights are protected through mandatory unit holder approvals for material decisions, and board representation is allowed for unit holders holding more than 10%. And one point to note, while InvITs have credit protection under SARFAESI, they are not covered under IBC, which means enforcement mechanisms remain somewhat limited for lenders. Moving on to the next slide, let's also dwell on the recent RBI draft regulations, which are issued by RBI for lending to InvITs. The proposal to introduce comprehensive lending policy covers appraisal, DSCR benchmarks, monitoring, and covenant mechanisms, which shall further enhance governance and risk management practices across the ecosystem. Restriction on debt structure involve bullet maturities or ballooning repayment structure is a welcome move and helps reduce refinancing risk. However, it may impact IRR for InvITs with long tenure or perpetual asset class such as warehousing, transmission, and telecom assets. Further, the stringent eligibility criteria such as requirement of a minimum 3 years of operational history of InvITs seeking bank funding could limit bank participation despite strong creditworthiness. In this backdrop, how final policy evolves will be an important monitorable. We shall not now conclude the presentation with key takeaway. The next slide is on the InvIT returns, where InvIT on an overall basis have generated superior risk-adjusted returns with the returns being led by distribution generating 11% and capital appreciation around 3%. We shall now conclude the presentation with key takeaways. CareEdge Ratings expects AUM to grow by rupees 1 lakh crore for FY26, driven by asset addition in road, warehousing, transmission, and renewable segments. While NHI's strong monetization pipeline augurs well for the road sector, HAM valuation and limited toll assets pose challenge. Healthy occupancy, moderate leverage, and strong demand outlook shall support warehousing InvIT growth. Transmission and solar assets have strong potential, though additions are moderated by long concession, availability of top-up, and holdco level equity infusion. Combined leverage for InvITs is expected to remain stable at 49% for FY26 due to increase in valuations owing to lower interest rates and raising of equity. InvITs have raised 88,000 crores of equity in past 3 years, ended March 31, 2025, and the momentum continues in FY26. While InvITs have strong credit profile, there is scope to enhance credit protection. Retail, mutual fund, and provident fund participation in InvIT remains low, indicating significant headroom for investor-based diversification. With this, we end over our presentation. Thank you. Handing over to Mamta from here.
Thank you, Palak and Mayur, for the comprehensive overview. A quick reminder to all attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Maulish Desai, to take the discussion forward. Maulish Desai is director at CareEdge Ratings for the transportation sector and handles the portfolio of infrastructure sector companies. He holds a bachelor's degree in engineering and MBA in finance and CWA. He is also an associate member of ICWAI and a certified associate of the Indian Institution of Bankers. He has more than 20 years of industry experience, including 18 years with CareEdge Ratings. Over to you, Maulish.
Thank you, Mamta, for the quick introduction, and many thanks to Palak and Mayur for wonderful deck presentation. Good evening and very warm welcome to all participants. We are in interesting times with respect to the growth in InvIT AUM and announcement of National Monetization Pipeline NMP2 by Government of India. In this context, today it is our deep pleasure to have four industry experts to discuss threadbare on the InvIT and share their deep insights before us. I would now like to introduce each one of them in the alphabetical order. Our first speaker is Mr. Ankit Kumar Singh.
Hi, Amit.
Sorry, our first speaker is Mr. Amit Kumar Singh. Amit is the Chief Executive Officer of the Investment Manager of Indus Infra Trust. Amit is Chartered Accountant and brings over 22 years of experience across leading institutions, including HDFC Bank, IDBI, and Citicorp Finance. Prior to joining the Indus Infra Trust, he also served as a Senior Vice President at HDFC Bank. Warm welcome, Amit, in today's session.
Thanks, Maulish.
Our next speaker is Mr. Ankit Patel. Ankit Patel is Head of Credit Research, Fixed Income at SSBC Asset Management India Private Limited. With around 18 years of experience across sectors such as oil and gas, power, infrastructure, and manufacturing, he brings deep expertise to the table. He holds an MBA in finance from NMIMS and BTech in electronics and communication. Welcome, Ankit, in today's session.
Thanks, Maulish. Hi.
Yeah, hi. Our next speaker is Mr. Gaurav Malhotra. Gaurav is the Chief Executive Officer of Sustainable Energy Infra Investment Managers Private Limited, which is investment manager of Sustainable Energy Infra Trust. He also served as CFO of the project manager of Cube Highways Trust and played a key role in M&A, large-scale debt financing, and investor relations. Prior to this, he worked in private banking with Yes Bank, Aditya Birla Finance, and IndusInd Bank. Gaurav holds a BTech in Mechanical Engineering from NIT Durgapur and PGDIM from IIM Mumbai. Warm welcome, Gaurav, in today's session.
Thank you, Muresh. Thank you very much.
And our fourth speaker for today's session is Ms. Meghna Pandit. Ms. Meghna is the Chief Financial Officer of IndiGrid Infrastructure Trust, bringing over 20 years of experience in investment banking and corporate finance across the infrastructure sector. She has been with IndiGrid since 2018 and also previously serving there as a Chief Investment Officer. She has previously worked in organizations including IDFC Bank and Deloitte. A commerce graduate with an MMS from University of Mumbai, she is a CFA chartered holder and holds a PG diploma in financial analysis from ICFAI. Welcome, Ms. Meghna.
Thank you. Hi, everyone.
Now it's time to quickly set the context. As seen in the presentation, InvIT AUM is expected to reach to 7.25 lakh crore as on March 31st, 2026, driven by roads, transmission, renewable assets, telecom, and warehousing. The government of India aims to mobilize rupees 10 lakh crore by FY30 through leasing of public infrastructure assets under NMP2, a strategy that will not unlock the significant capital for new infrastructure building, but also catalyze the expansion and deepening of the existing ecosystem. So, in this context, let me ask to Mr. Gaurav. Gaurav, how can InvIT play a role in India's infrastructure development and especially for energy transition? Can you share quick 3 points for the same?
No, Maulish, I think thank you first of all for having me. I think I'll just maybe share one theme which I think is important as far as energy transition is concerned, is to do with the whole concept of allocating domestic capital for the purpose of owning infra assets in the country. Today, for example, if you look at our pension funds, if you look at our insurance companies, if you look at just the retail participation in the infrastructure story of the country, is hardly anything. There are enough examples in the country today, which, or let's say in the world, where you have examples of Canadian pension funds who actually, as a matter of fact, invest a huge amount of money into real assets. There is the term that they use over there. So I think that's where this is the key gap that InvIT industry is filling. We're giving opportunity to people like us to invest into the infra story. Coming to energy transition, I think the key sectors focusing there is generally renewables, the generating stations, and the transmission network. Not too much on the EV side, not too much on the industrial decarbonization and all of that, but primarily focusing on the generator and the transmission. There, I think we have just scratched the surface. We just saw the numbers, the percentage of AUM of the InvIT industry in the power sector is hardly anything today. And there are multiple reasons we can double click on that as we go along. But I expect that not just the current portfolios held under non-InvIT structures have a potential to move into InvITs, but also we're looking at a $30 to $40 billion of capex every year for the next 5 to 7 years at least. All of that opportunity will be available where InvIT can play a key role as far as the development of energy transition is concerned.
Okay. It's quite interesting. Thank you for sharing that perspective. So, in this context, my connecting question is to Ms. Meghna. So, according to you, what role do you see that the InvIT will play here in bridging this financing gap? And what are the key opportunities and risk that stakeholders should mindful to ensure the sustainable growth of transmission InvITs?
Sure. I think to start with, Gaurav, in any case, has laid the context very well in terms of the energy transition, the kind of growth that is expected. And I think that InvITs as platforms provide an opportunity to developers to monetize and to also churn their capital and then reinvest back in this opportunity which is available. I think the numbers speak for themselves, and across roads, across power sector, various subsectors on the infra side, we are seeing tremendous opportunity. However, when you look at what are the sources of financing to fund these opportunities, there is always a question mark because there are only these limited vehicles available to fund on the debt side as well as on the equity side. And I think that is where InvITs can play a role. On enabling, or allowing developers to churn the capital and reinvest it back. Second is, I think, Maulish, you yourself mentioned about National Monetization Plan 2, which is talking about, public asset monetization. So I think there is a lot of potential for InvITs to play a role and, bring in domestic capital plus foreign capital and ensure that all these publicly owned assets are governed, are operated through the InvIT platforms. And that is where even the monetization aspect takes place, whether it is at the state level or state asset owned monetization or central, all put together. Same on the transmission side, on the road side, as well as various other sectors per se. So I think the framework through the InvIT structure is already available where it can provide the required liquidity from a monetization standpoint. It's a question of which assets come to the market, how transparent that process on monetization is, whether it is from from a private sector. In any case, we are seeing that. And I think many developers have looked at, putting up InvITs as a monetization vehicle. But I think a great large role can be played on the public sector monetization, which, where, as I said earlier, the framework is already in place.
Yeah, so it's quite interesting that this announcement of 6 lakh crore of monetizing the public assets to the InvIT, so that will provide significant opportunity. But the key area that needs to see is the state central versus state counterparty and how that concession agreements are strong. So that will
Yeah,
drive the
correct.
monetization pace. Yeah. So let's move to the next theme on managing the operations of large pool of assets. So within all this asset class, the roads have a relatively higher O&M risk vis-a-vis the transmission and the renewables. So on this context, I would request Mr. Amit to share his perspective on this, how technology is transforming these O&M, and specifically how InvIT is leveraging AI and digital platforms to enhance the operational efficiency across such a wide portfolio of road assets. And do you expect any cost optimization due to this?
Sure. Thanks, Maulis, first of all, to having me here. First, I'll take your maybe question on AI. I think AI, we have been witnessing in the last 6 months or a year or so, so much disruptive it has been. And I think it's a current market is a very blunt example of that. However, coming to this point, say there's a lot of scope to use of AI and digital platform for uses in preventive maintenance, I would say. So when, of course, when you have a larger pool of assets, of course, you want to have basically you burden the responsibility of a higher maintenance also. So just like having centralized digital dashboards for portfolio on an asset to asset basis, there's a wider monitoring, then real-time KPIs for say incidents management, maintenance status, GIS based asset mapping. This is what I think most of the InvITs would have been doing. And we also do this. Uh, Point to give it just to give an examples of AI. Like a lot of we have been in touch with couple of guys. These all are of course uh, uh, foreign players where they have started using say digital inspection of civil infrastructure with help of AI technologies. So like one of the companies I think we were in talking, they were based out of Israel, and they were explaining a technology where you are using basically drone based drones in order to understand the if which will go say below the bridges, below the structures, and they will tell you that if there are any cracks, example for them, and they will be like as minute as like 3 of cracks also they can basically tell you. Currently how we've been doing is we generally use MBIO, which is mobile bridge inspection unit, which will go down the bridge. You have to go and see. But of course, it's a human thing. You go and check. So there might be a risk of say missing out something or overseeing something. Here you don't have that risk. Now they can tell you, okay, this is the cracks will started developing in the bridge and how you can take care of that. Then again, they were explaining to us that there are some satellite based technology they are using where they will tell you the moist of like earth surface. So India, I think we have seen seasonal rainfalls, and at times the rainfall also gets elongated. So how it happens is that you also need to see that basically, because once the rainfall happens and there's any kind of crack is there, water generally has to go down. So of course some moist remains. So this kind of technology will help you in terms of preventing maintenance, where you can actually refill, you can take care of basically those kind of moist levels, so that proper settlement doesn't happen. So you can use AI, you can use your digital platform in terms of getting the data, in terms of getting in much advance in time, taking a preventive, proactive care of that, so that any lapse which otherwise could have arisen, you can take care of that. So of course, you can use. There's a lot of scope of using AI, your smart infrastructures, your digital platforms, but how effectively you use it to your benefit, that's up to you, because this is a decent capex, this is a larger upfront capex. So
Okay.
as an InvIT or as an any platform, you need to take care of that, whether that platform is ready to do that kind of capex or not. And of course, the impact of that comes over the next 5 7 years, 10 years, 15 years period. So uses are there, yes, definitely. How it can be, that completely up to that particular person or organization. Yeah.
Yeah. Thank you, Amit, for sharing this important perspective. Mainly, you mentioned about the use of drone and geospatial technology to for the preventive maintenance of the road. So that's quite insightful. So moving ahead to Mr. Ankit for the lender's perspective. So as InvIT is well accepted and also in terms of credit worthiness, also it stands on top. However, if we look at from the lender side, so there is a limited credit protection available on a bankruptcy. So how do you differentiate between funding at a InvIT level and SPV level?
Yeah, thanks, Malesh, for having me. I'm happy to be the only one from the lending side in this panel. Uh, but yeah, just to touch upon the fact that the bankruptcy part, to be honest, it has been there. It has been around. I remember SBI managing director. I think he spoke about it in 2024 and talked about bringing this particular aspect into the IBC in order to include InvITs. Of course, there are challenges in that, and even in the recent IBC bill, I don't see that this has got added into the mix. Although there are a lot of other changes, positive changes that are happening for the lender protection in that bill. But to be honest, see, I think whether it is the banks or it is us, we also fund unsecured debt. So I think the lender protection aside, I think the credit aspect of it is something that we've already been assessing and already found to be fairly good. There is already an underlying comfort of cash flows, proven structure. If you had asked me this question in 2019, yes, we were circumspect. We were wondering how this will flow, but today we are 6 7 years of history. The model has got tested. The governance, which was also something that was, uh, I mean, something that we wanted to see, has also got fairly tested. Um, you can see that there is participation happening across the board, at least in those InvITs which have proven that track record since that time. And as new InvITs come into the fray, I think gradually lenders do find comfort on the process that they follow, on the things that they do fairly well, and the kind of investor depth that starts building into whether it is their equity book or whether it is their lending book. Uh, as far as our concern, I think capital market participants like us, uh, we would lend to InvITs. The only issue that we currently see as such, we would generally build a credit a comfort on a particular issuer, and then there is always a liquidity spread which we would expect because our funds keep going up and down. We should have the comfort that a particular uh, a bond that we hold, we will be able to generate liquidity by doing a secondary sale when required. And that is something that is yet to be completely uh, proven, I would say. That is the reason why there is less holding of InvITs also today with the asset management companies. It is building. That liquidity spread was much higher before. It has come down over time, and I believe it will eventually vanish once all of the InvITs are held fairly widely, and there is enough comfort on of a track record of management of governance in various names. But I think the IBC part is also something, if it gets addressed, it's obviously going to be a positive because it will bring initial additional participation also in a way of saying that there is that protection available as well. At the moment, one would think that if there is um, there is no protection on that, it's at least something to be considered. So let's say you start with a basic IBC related kind of a risk initially, which I feel is a little bit small when you look at the cash flows and the tenor that we do. The second thing is, of course, the liquidity spread, which probably needs to come down in the future. And I think the third part in this is obviously as capital market participants like us, it is always a point in time, and the kind of tenor that we can do. So I think while all of these InvITs have a very long concession period, remaining concession period, generally 15 years, 20 years, 30 years in some cases, uh, typically the asset liability matching for us, our funds are typically in the 3 to 5 year segment. If you see the large part of amount that we have for investment is in that kind of a tenor space. If there are going to be InvITs who are going to raise money in the 10 year and the longer tenor, we will find it difficult to participate. So yeah, there are all of these different angles. And yeah, let's see. From that perspective, it's always moving in the positive direction, and it's only about matter of time when we become at par with how the banking also lends to the InvIT space. Yes.
So well articulated, Ankit. So broadly, your response also does echo with our rating experience. Then when the rating is derived basis the pooling of assets and the cash flow strength. So therefore, the most of the InvITs are rated AAA. The key points why that limited participation is there from the mutual funds is you are saying is the asset liability mismatch related aspect, and second, the limited track record of selling into the secondary market. So these two are important points that you bring. So now moving to the next round of discussion on the challenges, perceived challenges which are there for monetizing the each asset class going forward. So beginning that, I would like to invite Mr. Amit to share his views on the roads. So as we have seen also in the presentation, so large chunk of operational toll roads have already been transferred to the InvIT. So there could be some possibility of the change in hands within InvITs, but the limited assets is available with the developer, especially operational toll road for the sale. And for the HAM assets also, now the whatever the projects which are which will be operational from 27 onwards, those were with the aggressive bidding, and therefore it will have a limited valuation multiple. And banks are also giving the top-up loan. So in that context, do you see any slowdown in the assets, especially from the private developer fronts to the roads InvIT?
So, Molish, I'll just take this question in maybe two steps. First thing is that yes, in the first set, whatever got bidden in 2016, 17, I think either they have changed hands or the people have, as you rightly mentioned, they have taken top-ups on that. So are they available? No, because a lot of people who did their own InvIT or it went to say other InvITs like led by financial sponsors or
Mm.
mm, yeah, financial sponsors only because developers put their own InvIT, so they are transferring their assets in their InvIT. Whether good assets are left, of course. I think my quality is a function of how much money I'm going to put in building that a specific product. So I think with excessive bidding, what we have been seeing over the last 2 3 years, I
Yes.
think that has a catapulting effect. You can say basically into the final product which is getting constructed. Yes, we are seeing that. Are there are a lot of assets which will be available? I think maybe I may have a different view, but I think yeah, a lot of assets are not available. Reason being that the good assets, of course, they have ideally got the buyers, so they'll find the buyers, and you can see a good competition. And I think what has happened that because of this excessive bidding competition, the assets have started or the projects have started changing hands, or maybe they've started bidding to maybe in terms of I'd say revenue wise or maybe profitability wise, not to a tier one, maybe to a tier two, tier three, because who are the guys who are more aggressive? Am I generalizing that all the say not so bigger guys will not be doing the quality construction? Answer is no. Of course they can, because as you grow bigger, your cost also increase, and once if I am say small enough, I can go to my site myself and I can conduct I can do a better work rather than giving outsourcing it or sending it to my person. So generalizing is not easy, but yeah, whether all the assets finally once they get ready will they change hands? Answer is no, because at the end of the day earlier when the 100 was the cost and somebody used to bid at 120, suppose he took side on a 120 price also, I think the cost of construction used to be 100. Now that sell bid size is changed down to 80, and now somebody is bidding at 70 and he's taking 10% profit and he's building at 63. So the difference of 63 and 100 will be seen, and that is being seen. So, in terms of ham, I think we are clear. At least I am clear that you won't get much opportunities, and the select opportunities will be there in the good quality, not from the bigger ones, maybe from the smaller ones who have taken up. And we are seeing the examples also. It's not that a couple of
Yeah.
smaller contractors have begun, have produced a good product. To the toll, I think this is a cycle, as you rightly said, because uh, I think so-called, the bigger platform, they have taken a lot of toll projects already. So now whatever new, so last year I think we saw just two toll projects, I think, which was, taken by the two contractors. And after that, I think NHAI with the new MCA, they will be awarding some more toll. But that will take time to get ready because the construction will take 2 to 3 years, and then after 1 or 2 years it will come. So we can see a cycle wise. I can say all these assets will start coming into say for acquisition maybe 2030 onwards. And in between, anybody who has, say, a decent pipeline, they can keep showing the growth. Otherwise, people will, maybe struggle for the good quality for the toll roads. However, if NHI keeps awarding TOTs, which we are not seeing that that's so frequent now,
Yeah.
that will be up for grab by the InvITs and depending on who takes what stance. So yeah, there will be challenge. I'm not saying it's very hungry dory. While the numbers are good, we can say basically with this NIP1 and NIP2. But I think when it comes on the ground, you see challenges in terms of good asset acquisition, quality asset, which will change hands.
Okay, understood. So big message that what can I gather from you is that the in HEM there will be some challenges in the monetization because of this bidding aggression and quality, but some inventory is still available, and InvITs with the own developers they have an edge to transfer those assets. And second, the toll obviously the once the TOT bids come out and this under construction projects become operational by 30, the next pool of asset would be available to the market. Understood.
That's what I see. Yes.
Yeah. So now I would request Mr. Gaurav to share his view on these renewables. So given this aggressive bidding trends and tariff discovery for the renewables like by set at 2.9 rupees per kilowatt hour and delays in signing of PPA, and also there are inherent technological risk related to the batteries, and top out with there is a likely uptick in the interest rate. So do you anticipate any slowdown in this asset transfer to the InvITs from the renewable fronts?
No, no, I think I similar issues that Amit just highlighted, no, on the road sector.
Yeah.
Similar issues are there. It's the same group of people who are also bidding at times. I say it's honestly it's true also. And just to give you an example, in one of the recent bids, there were some 60 bidders in one solar BESS project, right? And the tariffs range from so the 6 hour battery storage project, solar plus BESS project, which came up. I think it was Seki or someone else, but it the tariff varied from 3.12 to all the way to 3.97, and there were some 40 to 50 bidders in that particular this thing. And if you look at the list of bidders, some of the tier one, if I may say, were at the back end, and some of the new names were in the front. So I think it's a similar issue that is there. I would maybe add a few more points which are not as common as in the road sector, which is to do with the technological risk and some of the assumptions on how these assets will come about. So a lot of assumptions are taken, for example, on the round trip efficiencies. A lot of assumptions have been taken on the O&M cost, how the warranty will work, how the degradation will work, etc. I think all of these things have to be tested as far as BESS is concerned. Also, we need to be sure that we have the enough O&M capabilities on managing our best portfolios. I think you'll find that we will see similar to what we have seen in solar. And solar has been now in the industry for last 15 odd years now. BESS is just starting out. So I think all that skill capability will have to be built in to be able to ascertain exactly whether we have the capability and what is the on the ground response of some of these things. And the last factor is also the fact that when you look at some of these bids, right, you also are taking into account how much of oversizing you do on some of your solar capacities, right? And the amount of oversizing is dependent upon a lot of other factors also, whether you have the enough connectivity, whether you can actually supply that during the day to the grid, etc. Are you taking any liquidity damages call, for example? All of these things will have to play out over the next 12 to 18 months to actually first ascertain whether we from an InvIT perspective, because see, at the InvIT level, what we're looking at is predictability of cash flows. That's what we are selling to our investors. We need to have enough vintage of for some of these assets moving forward, then only we can take some of these things. Just last point on the exit part, right? I think bidding and all is fine. Again, this is just a repetition of what Amit said, that ultimately these assets will only come to the InvIT if there is a capital appreciation that the developers see on the sale. And the finer the bidding prices are, the more difficult it's going to be. So I think that's the other factor that one needs to take into account.
Yeah. understood. So broadly, what you are saying is the bidding aggression is also impacting the renewable front, and many of these road developers, they also forayed into this space. And in our experience also, we have seen the lenders are seeking for the higher threshold of DSCR for the best projects, therefore, and keeping the stringent assumptions of the round trip efficiency to mitigate those risks. So now I request Ms. Meghna to step in here to share her views on the transmission
Sure.
and as well as the base projects. So one on this bidding aggression front that we have observed, and second, the top-up loan availability is also there in the transmission projects because of the longer concession. So do you believe this thing was one of the constraint for the portfolio addition?
So I think commenting on the first part in terms of on the transmission or battery, I think what Gaurav mentioned made a lot of sense. Just one thing, all of us who have been in the infrastructure sector for the last 2 decades at least, we have seen these cycles coming in. Earlier it used to be, we've seen these kind of cycles on the thermal power plants. We've seen them on the renewable side. Now it is something that we are experiencing on the battery energy storage. And I think it's a question of, what kind of developers are participating and what kind of quality assets are coming up. What we perhaps, I mean, the worry is that if bad quality projects, and especially on the battery side, if they come up, then it makes the risks which were earlier perceived, that there could be fire risks, etc. If those actually start becoming the reality, then it's an industry-wide problem which will need to be addressed, right? And I think that perhaps, and we understand that the policymakers are also looking at it to ensure that, the competent developers participate. So the qualifications which are required while participating in these bids, if they can be made a little more, I would say, stringent and looking at actual track record of having built these kind of capacities will perhaps help. So I think what we are experiencing is this exuberance right now on the bidding side. The other point, of course, is whether these capacities will come up, because even today, at least on the battery side, there is dependence on importing the batteries. The manufacturing capacities are spoken of getting built in the country, but I don't think in the visible future, or I would say foreseeable future, there will be still some time when these manufacturing capacities in the country will come up. So yeah, I think these challenges continue to remain. From an InvIT standpoint, whether it is on the transmission side, whether it is on the BESS side, of course, it depends what kind of growth will there be. My sense is that the underlying factors on the greenfield side itself are very, very robust. So there is capacity that needs to be built in, and especially on the transmission side, where I think the presentation spoke about whatever 6-7 lakh crores are numbers, both battery and transmission put together. Some 9 lakh odd crores of capacities have to come up. And I think those kind of numbers, when we speak about, there will be a lot of developers who will participate, and there will be some pipeline which will certainly come into the market, right? Whether that comes in the next 12 months, 18 months, etc. And I think there, with the regulations on allowing InvITs to dabble a little bit on the under construction side. Similarly, what we have done at our end is create EnerGrid, which is a development platform, wherein as IndiGrid, we are limiting our exposure during construction. But then once the projects become operational, we will acquire those. So essentially, there is still, we are trying to create that visibility on the pipeline bit. So it also allows us actually to have control on the quality of the asset that is getting built. So, I'm sure that there are ways through which across subsectors, this is something which will, in any case, be looked at. So to my mind, I think from an InvIT standpoint, where the growth that we are talking about, and as I think Gaurav mentioned, it's ultimately predictability and gradual. So even when the kind of investors who are looking at InvITs, it's not like on a quarter-on-quarter basis, there is that growth expectation. It is ultimately whether there is consistent growth which is being able to be delivered by that platform. And that kind of capital will be attracted by these platforms also. So, it's a combination of all of these things, and we will see, different kinds of models being looked at, of course, being within the framework of the overall regulations that we look at.
Yeah. So thank you very much for sharing this perspective. So the main message is that there is a need for enhancing the transmission infrastructure, and there is a strong pipeline. So from that perspective, definitely the growth opportunity would be there.
And I think if I can just add to it, where we earlier talked about, let's say, the national monetization pipeline or just the monetization bit which we are talking about. So Ministry of Power has come out with AOMT guidelines, for example, in terms of specifically on the transmission side. There is already a model or the guidelines which have been put up in terms of how the transmission projects can be monetized. Now, whether there is enough will to, implement those guidelines at the state and the central level, but I would say that the guidelines certainly enable the government to ensure that without losing control on, let's say, or ceding control for a matter of 25 or 35 years, it can exchange hands, and let's say whether it is private sector or InvITs or both get to operate these projects, and then the ownership goes back to the government. So these things also, our sense is that that needs to be tested, and there is enough opportunity. Now, whether that will actually come to the market is something that remains to be seen and will depend on a lot of, I would say, regulatory will to bring it to the market.
Yeah, understood. So thank you very much for sharing this perspective. So now coming to the Ankit on this funding side. So since there is a pipeline of for monetization, the funding is also equally crucial. And recently RBI has come out with this draft guideline wherein there are restrictions on the bullet repayments, and also there are restrictions on the ballooning repayment as well.
Ballooning.
So what's your take on this, all this? Even a leverage cap, they are saying 49%.
Right. And they have further left it to the banks boards to actually decide what leverage
Yes.
cap they want to have. Of course, I think intent of the regulator is always to ensure that there is enough balance in terms of what is done and what is left to be done. So over here, obviously, they are looking at protection for the lender in all respects. As I was saying, track record is important. So the 3 years of operation, 2 years of positive NDCF, all that is something that the regulator, or rather the draft guidelines, are trying to build in. We should not preempt what will come in the final guidelines. I am sure the participants on this panel, as well as others who are bringing in their InvITs, are going to reply and try to bring down the requirement, if at all the regulator agrees eventually, of bringing down that requirement. But I think the idea of the regulation obviously is to reduce the lending risk to the extent possible for the banks. The fact that they obviously, we have that IBC issue at the moment already. It's better that just a brand new structured InvIT, which has not proven the governance and other aspects, does not get to borrow in the same manner that a well-proven track record having InvIT does. Ballooning repayments, of course, why should there be ballooning repayments? I would think in a HAM kind of a project. Of course, it should be asset to asset wise, because the variability of the cash flows should allow for a ballooning repayment structure. I think as a blanket, they have simply said that that will not be allowed at the moment. The idea is, can you predict what is going to happen in the 7-8 year down the line timeline? There are major maintenances involved. Um, uh, 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 I think just to bring down that aspect and to have a very smooth balance in terms of amortization of the debt is where the intent seems to be. Um, it is, and your presentation, you highlighted, where it will bring down the return in terms of the refinancing when it is done, and what it will not leave as much as it could for the equity investors. But I think just to take a step back and to understand how it is happening right now, let's just look at the risks that are involved. A lender is probably taking out what 7.5% from a financing done to an InvIT. A unit holder uh, and your returns, the returns that you showed, is probably taking home more at the moment, right? Uh, the idea is I should have better protection compared to the unit holder, because I am anyway, as a lender, I'm getting lower return as compared to the unit holder. But that is not the case in terms of the protection and the other aspects that there may be there. So I think some of the balance will come over time. One should take it positively only. The liquidity that I mentioned, which is not available to us when we want to do a secondary sale, I think all of that will improve only. Um, uh, in InvIT anyway, I think at least uh, I would think it's a little bit of a small negative for the InvITs who are already in the game. Uh, it's actually the REITs who are looking for this particular relaxation of banks participating into REITs, and together I think the regulator has decided that let me also revisit how the lending to InvITs happens. So it is in a way just a more cautious way in which regulator wants to also bring the new InvITs into the purview of some limitations. In any case, the banks are going to take their own call, as is mentioned, 49%, and all of those other things have to be revisited by every bank. The banks have to formulate their own guidelines, their own rules, and we are doing that for ourselves anyway. So I think overall, uh, it's 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 positive, I would say, for the industry and for the secondary investor depth to build up in the future. Um, it can only be positive in the long run because as they were as you know, the other members were also mentioning, people who are holding the uh, InvIT bonds, they are either a hold to maturity kind of a investor, or they are really long investors. And to that extent, how will a secondary develop if everyone is hold to maturity? So I think somewhere bringing in more and more investors and more different structures into the mix, it'll all be positive only from a long-term perspective.
Yeah, understood. Thank you, Ankit. So moving to the investor perspective. So as we have seen in the presentation, the InvIT is offering the relatively better returns as compared to some of the investment class. However, if we see the retail participation in InvIT, so that is limited. So my question is to Ms. Meghna, that what all needs to be done to increase this retail participation in InvITs?
Well, to be honest, when you say it is limited for us, the way we have experienced it since 2017 when we got listed till now, we started off with something like 400 or 450 odd crores of retail participation when we got listed in 2017 versus today, which the retail component is somewhere about 30 odd percent, almost about 4,700 odd crores. So it's a 10x jump that we have seen the retail participation. I think our overall unit holder book itself will be more than 50,000 odd unit holders. And so to me, if you look at it, there has been an evolution in terms of these platforms. REITs are intuitively known. They have been there globally also. People understand that, with real estate, this is how it works. But with InvITs, I think investor education or just understanding what these platforms are, how do they work, what are the governance structures, etc. It's taken some time. And I would say regulations certainly have evolved over a period of time. And they have contributed in improving this retail participation. I mean, starting from a lot size of 5 lakh to start with, to 1 unit for publicly listed InvIT, and now even for the privately listed InvIT, the lot size has been brought down. So that is certainly contributing in improving the liquidity. I would say that besides that, investor education, I would say, is prima facie most important one, which through the InvITs association, there are various measures which are being taken up. Individually, also a lot of InvITs, including ourselves, we participate in a lot of forums just from spreading or explaining what the InvITs constructs are like. Second, I think to improve liquidity, of course, is ensure if we can see how there can be index inclusion. And again, from personal experience on the IndiGrid side, we got included in two passive indices last year. FTSE index is where we got included, and we saw its impact in terms of passive flows increasing and the liquidity automatically improving from a unit standpoint. So I think from a regulations perspective, if you ask me what is required, then index inclusion Whether that happens by classifying InvITs as equity or equity like or some other way is something which I think all of us are working with the regulators. But ultimately, where it needs to be led is if there is index inclusion that comes through. Market making is another, I would say, aspect, but regulations around market making and how exactly to bring that forth is something that needs to be evolved. But to my mind, I think as more InvITs are coming to the market, also I think a lot of private InvITs are getting converted into public InvITs, which is another way through which, automatically there will be a lot of participation from the retail side, which will come in. And once that happens, there is liquidity which also gets built in. So I think it's a combination of all these factors which I think will eventually help in building it further.
Okay, understood. And in fact, NHI is also coming with their public listed InvIT, especially to boost the retail participation. Their
That's right.
target segment is this retail participation. Yeah. So my next question is to Amit. So on the same front, what are your views for improving this retail participation as well as the domestic participation?
Molish, I think Meghna has covered this point decently. I think whether it's index inclusion or market making. So I think just one thing I would say that see anybody if he will participate only when he's aware about that thing, right? And awareness will come from the knowledge, and knowledge basically finally who will make him who has to go and do that effort to make him knowledgeable, right? So that he should understand. I think if you ask about my thing, yeah, I admit that there should have been more participation in my InvIT. But thing is that again on the softer side, do my parents know that what an InvIT is? I don't know. I need to go and check with my father, but still he understood whether he knows what the InvIT, where I'm working. So it's a very complicated thing, to be honest. When we started doing, the InvIT, basically it's your SPV shares which will get transferred into a trust. Then trust will, issue in units where you will basically, that will get traded, and you can hold one unit because I was a public. It was not that easy to, explain. Though integrate PGCL, they were in, and IRB was there for the last 4, 5 years, 6 years when we came. But then what happened when our IPO happened, a lot of time that time investors came in, they came for the IPO pop. Like, okay, you coming at 100, I'll sell it at 100, 300, 500, 10, which an iron doesn't, didn't happen. So when we did IPO, it was, I think 37, 38,000 unit holders were there. And till large, I would say actually in month of July, August, it came down to 27,000. Then what happened? We started talking to lots of guys, and of course, we used to get weekly reports. Now I can tell you this number has almost crossed 34,000. 34. I think just touching 35,000. So there, I can see in my case also last 6, 7 months, 7,000, say 7, 8,000 new unit holders have got added. But how did it help? Because a lot of times we started having calls. We started meeting a lot of family offices, a lot of HNI investors, explaining them that because this is like they used to understand that yeah, there's an InvIT, they give you 10%. But then how we started explaining them, then of course, and it's also a function of whether somebody who's holding, say for example, in somebody's case, the sponsors are holding 50, 60% and they are not selling. You have a big institutions who are again holding 15, 20% and they are not selling, they are not trading rather. Then how will this trading happen? How this say liquidity will improve, right? So of course market making is one thing, but at the end of the day somebody should be able to sell so that somebody should be able to buy. So once happens is, and that will come with the of course you need to diversify your investor base. Should we get different kind of investors rather than just like mutual fund or an insurance company? Again, insurance company, pension funds, they are not going to trade, right? So do you have those kind of investors who actually are the market makers? If they start participating, like Meghna rightly said, if you get included in the passive index funds, then of course, because of underlying nature of those activities, your volume increases. But at the end of the day, I think at the core of it, I think it's more like you need to go and explain to the people, right? Or who are the investors, that this is a different product. I can't give you a 20, 30% in 1 year, but yeah, you can be better sure about say X percentage over the next number of years. And I think the target, if I go to a Gen Z and ask for them to invest in InvIT, I don't think it's going to work, right? But yeah, if I go to a say a retired or maybe going to be retiring who wants to actually do asset allocation. So I think as a manager also, rather than understanding the underlying asset, we also need to understand what is asset allocation, who's the target investor. Because if I talk to a Gen Z and say that you just invest your 50,000, he won't, right? But a retired person who has a 10, 15, 20, 30 years, I think then any InvIT is a good product. So I think for us to understand in the most basically peculiar way, targeting those kind of investors, understanding their asset allocation, and then advising them, because it may be that for some a road InvIT may not work, maybe a transmission InvIT will work, to be honest, right? Because transmission has a 35
Mm.
years, road is a say for example 13, 14, 15 years. But you need to be that honest to tell that guys that, sir, are you looking for 30 years, then I'm not the paper. So, that kind of honesty and that kind of preparedness in your mindset, I think all this put together can help in, basically people making aware and then in turn, increasing liquidity. Yeah.
Understood. Yeah. So we will take the audience question shortly. Meanwhile, my last question is to Gaurav. So, according to you, what are the top 2 or 3 reforms that you can recommend to deepen India's InvIT market and improve investor confidence? After that, we
Oh,
will take.
thank you, Malish. I think on the reforms, to be honest, let me start by saying that SEBI has done an excellent job on the InvIT regulation. They have been very proactive and they've been actually listening to all our issues. And I'm talking on behalf of the industry now. They've actually done a great job, and through Bharat InvIT Association, we keep on discussing ideas with them, and they've been very very forthcoming. So I'll just maybe just put that also on record to start off this point. I think on the reform bit, maybe just couple of things which I think from a mid to long term will be important. One is to do with the whole funding sources, right? I think there's a good amount of work that still needs to be done in getting the point that I made on the pension money and the insurance money to come into the InvITs, both on the equity and debt side. I think it's very important to talk about debt also. There was one study which recently came to my desk, which was talking about the fact that the entire infra financing of India can happen just by domestic capital alone. We don't need a lot of FDI. If you just look at the quantum of savings that is yet to be tapped as far as the infra story of the country is concerned. So I think it's very, very important. There are things like 10% of particular issuance size an insurance company cannot invest, and all of those things I think need to be really looked into, and something can be done. The second part, which is a point which I think Meghna also highlighted, is to talk about the under construction addition of some sort of capability there, and also the capping that is currently there. I think maybe we understand the fact that for new InvITs, there's some track record that needs to be built, but some InvITs who have a 2 year, 3 year, or 5 year track record, maybe some relaxation on the percentages that can go into the under construction space. It just allows more flexibility as far as the management capability is concerned. So I think these are a couple of things that I would highlight. But I think these will help from a mid to long term perspective, both on I think mostly on the growth side, because you'll be able to access to more funds and you can then deploy in newer opportunities.
Okay, understood. Yeah, so there are many questions from the audience, so in line with expectation. So my first question, it's pertaining to the banking, so I would like to ask to Ankit. So the question is from Sivaram. He is asking that the recent drafts RBI circular has pointed for bank that the loan should be fully secured by charge on the identified asset. How this will be implemented, and what could be the difficulty in operations for InvIT?
So I think even in the current even the current way the borrowing was happening, InvITs are allowed to provide a security on the underlying SPV assets.
Cash flow.
Uh, Same thing is happening on the REIT side as well. So I think it is possible to give an underlying security. Either it could be on the shareholding, of course, of the SPV. It could be on the assets. Uh, so there has to be that kind of an exposure, and there has to be some. So there are already bond issuances that have happened at the InvIT level, right? So bond issuers are already built in a way or a manner in which this lending can happen. and the way security can be passed through. So there will be, I think that may not be such a big challenge, I would think. But of course, whatever security happens, of course, the IBC part is also something that eventually needs to come through, because what is the meaning of a security or a charge unless there is a there is a position at the table of creditors eventually, in case there were to be such a situation. So I think uh, again, all of those things, those are technical points which all lenders will consider, and that will be factored into how they lend.
Understood. So next question is from Mr. Deep Vakil. So that is with respect to this NMP2. NMP2, the theme is now that multiple sectors InvIT. Earlier, there was a sector-specific InvIT. So the question is that how this theme will work out, the multiple sector InvIT, multiple sectors assets to be added in the single InvIT vis-a-vis a sector-specific theme earlier. So anyone you, Gaurav or
Yeah, maybe I'll just take this Deep's
yeah.
question. So I think what we are saying is, and it's a very pertinent question, that say what happens is that if there's a growth concern in any specific you know uh, underlying class, whether it's a road, transmission, maybe renewable, solar, whatever we take. So how will you take care of that? But at the same time, you have a different investors, different appetite, different risk profile. Now the idea is to manage both, because at the end of the day, somebody who's investing a 30-year concession cannot expect a 15-year, right? Sorry, 15%, and somebody who's say investing in a toll cannot expect a 10%. So now thing is how to basically manage these both expectation. I think one thing is that maybe this multi-class or multi-asset class investment will be also a function of how the investor mindset involved. And I'm particularly saying institutional insta investors. Retailers, they'll understand, because they will agree to say they used to get 12, now they are say getting 11 and a half or 11. I think they will come around that. But thing is always how insta investors come around that, because what happens in the same in the same uh, investment house, maybe transmission will be looked at by a separate guy, and the road will be looked at by a different guy. And then when the of course the farm level discussion happen, you're at the CIO level, he may agree to certain, but the different analyst level or maybe a fund manager level, the maybe differences in the expectations. Now
Yeah.
that I think once, so this is an evolution of thought process, I would say. And that may not happen just in one go, and the moment you just introduce something without checking with investors, without understanding their expectation. And I think once that evolves, I think that then because I think with uh, it's with I think Rajmark that has already started, or maybe at least their thought process is started, initiated. It
Yes.
will be also a function of that how investors are guiding those investment managers to look around that.
Understood. Yeah. So the next question, I think, is to Gaurav. So the question is, considering the implementation of ALM 2 and 3 by 2028, where does the solar sector stands and how it will impact the monetization of assets under InvIT?
But again, yeah, thank you, Maurice, first of all. So again, come back to the same point of whether the tariffs or the capex rather would go up because of this whole cell now also being needs to be procured from domestic sources, and also the whole thing becoming more stringent as we go ahead in time. So again, it clearly seems to us that given the percentage of capex which the module really comprise of in a project cost, and the fact that the cell cost getting added because of is the cost of modules going up, there can be a 15 to 30 basis paisa of delta on the tariff that can come. Now, all of that will have to then translate into the capex that is required and the tariff that is being bid for, and whether that makes sense or not. So again, it all comes back to the same point, that whether a proper bidding scenario was built up, whether how realistic was that, whether the right tariffs was there, and then the project was delivered within the time and the cost that was initially estimated. All of that will have to look. So we go back to the same parameters that we discussed earlier. If all of that sets well, the developer makes a reasonable amount of return on their capital, and then the assets can be offloaded to the InvIT. So it comes back to the same fundamentals we spoke about. So it's just a change in the capex, which ultimately will result into a higher tariff. And as long as that is taken care of, it is fine.
Understood. Yeah. So there are other questions also, but due to the paucity of the time, we will take this last question. So this is to Ms. Meghna. So the question is on the competitive intensity in the transmission platforms also. There are multiple platforms, and now government is also allowing PGCIL platform to bid for the under construction project. So what type of competitive intensity do you expect for that InvIT platforms?
I think the competitive intensity for transmission has always been there. And I think what Deep is referring to is the announcement where PGCIL has enabled, investment into its subsidiaries. And because it's a PSU,
Yeah.
there were limits on PGCIL investing equity in their subsidiaries, which was 5,000. Now that limit has been increased to 7,500 odd. So it's not that PGCIL was not looking at bidding or something like that. That has always been the case. I think this is more of enablement to increase the size of equity investment by PGCIL into its underlying subsidiaries, which is the development that he's referring to. Coming to the competitive intensity, as I said, it has always been there. But I think the way we look at it is, the pie size itself is very large. I mean, in the presentation itself, we saw the kind of transmission capacity that needs to come up, right? And I think just to talk about here and now, the open bids on the transmission side, RFPs, which are there, are about 83,000 odd crores. And another 40 odd thousand crores worth of projects are in the planning stage, and the RFPs will come out soon. So I think there is enough room for a patient developer to participate, plan for it, and ensure that they are able to, participate in the bids and win projects. So to that extent, I think fundamental drivers remain pretty positive, as I mentioned earlier as well.
So I think we have very interesting session today, and more important, we have gotten a clear answers from all the industry experts. So thank you once again, Amit, Ankit, Gaurav, and Meghna for sharing your deep insights and patiently answering all the queries of participant. I am privileged to host you all in today's session. Thank you once again. Thank you all the participant for joining the session today. Thank you very much. I shall now hand over the session to Mamta for closing remarks.
Thank you, Maulish, for steering such an
Thank
insightful
you.
discussion.
Thank you.
Yeah, thank you,
To our
Maulish, and thanks,
participants,
Maulish.
thank you for joining us and engaging with us today. We look forward to your feedback. For any further queries and suggestions or comments, please feel free to respond to the feedback mail you'll shortly receive. Goodbye for now, requesting the tech team to kindly log off.
Thank you. Thanks, everyone.
Thank you.
Thanks.
Thank you.
Bye-bye.
Thank you, everyone.
Thanks.